Welcome to the AM&AA Wednesday sessions. We are going to start this morning with a State of the Market panel. And I'm Graeme, Frazier with GF Data and also a company called Private Capital Research, PCR. We do buy-side M&A. And at GF Data, we have a database of private equity transaction information. Just want to start by doing some self-introductions of the panel that we're going to have chatting today, talking about state of the market, some valuation, volume, leverage characteristics, and other things that are happening in the lower middle market M&A world. So Homyar, please introduce yourself.
Sure. Good morning, everyone. I'm Homyar Choksi with LBC Credit Partners. LBC is a debt fund which provides financing for buyouts, refinancings, dividend recaps, etc., to middle market companies. We define middle market companies as companies with EBITDA north of $5 million, typically between $5 and $50 million. We do everything from senior secured transactions all the way down through mezzanine and equity co-invest, so a one-stop lender. And since we were formed in 2005, late 2005, we've deployed over $5 billion of capital, currently investing out of Fund 4.
Ryan? Great. Can everybody hear us okay, by the way?
Yeah.
Louder.
All right. Morning, I'm Ryan Chimenti with Cleary, Gull. We're a lower middle market investment bank based in Milwaukee. Our firm's a generalist firm. Our target market is 3 to 15 of EBITDA. Half of our clients are private equity firms, half are entrepreneurs, and I'd say 50% of our business is Big Ten states, and 50% is rest of country. And being based in Milwaukee, I'd say 50% of our business tends to be highly engineered manufacturing companies, and then kind of the rest of world is the other 50%.
Everybody.
Brian?
Yep. Hey, everybody. I'm Brian Garfield. I'm a director at Lincoln International. For those that don't know, Lincoln International is a global middle market focused investment bank and advisory firm. We closed 190 M&A transactions in 2017 and have arranged about $10 billion in debt financing over the course of the last 5 years. I sit in our valuations practice, which focuses primarily on the valuation of liquid financial instruments. Those financial instruments predominantly sit in the middle market. We value about 1,300 middle market portfolio companies on a quarterly basis.
Jason Van Zant here in Chicago at Keystone Capital. For those of you that don't know Keystone is a lower middle market private equity firm. We've been around for about 25 years, investing in primarily business services, consumer and industrial manufacturing oriented companies. What's a little unique about Keystone, so that part of the story is not really that unique. What's a little different about Keystone is that we actually operate more like a family office. We invest our own personal capital from within the firm as opposed to institutional third-party capital, and we've been doing that for 25 years. So a little bit, sort of disconnected from the fundraising and institutional capital market. But been in the market, been in lower middle market for 25 years, businesses doing 5 to 10 million of EBITDA. Haven't really changed off of that for the past 25 years. So, this is where we've lived, for several decades now.
All right, well, thanks, guys. Thank you all for taking the time to come and join us, too. Obviously, we got a good group here of highly experienced lower middle market M&A leaders. So I'm going to I'll talk for just a minute or two about some of the, which I was asked to do from some of the data that we have from GF Data regarding lower middle market M&A transaction information. GF Data has a database of valuation multiples, debt multiples, and pricing, key deal terms, et cetera, from private equity completed transactions that have between 10 and 250 million of enterprise value. And I definitely see a lot of familiar faces in the room, so I know some people are familiar with it, some others may not be. My partner, Bob Wegbright, is in the room. We've been a sponsor of the AM&AA for many years and have found this to be a wonderful environment to do business. So our most recent report includes data through Q1 2018. The Q2 data is in the midst of being collected and processed right now. We usually publish reports about 6 weeks after the end of a quarter, so first or second week of August, we'll publish the report with the Q2 data. Q1 data is always a little bit hard to really take too much faith in because the volume is usually down on average about 25% in Q1 versus the prior Q4. A lot of deals get done in Q4, as we all know. There's usually a rush to the end of the year, and Q1 typically has about a 25% drop off in deal volume, and this year that was the case. We saw also a drop off in both deal volume and valuations in Q1, but given the nature of the volume and the deals that we collected from our group of 265 private equity sponsors that contribute data to GF Data, we feel it was better to kind of average the Q4 and the Q1 numbers when you're thinking about what's really happening in the market. And we've had a sustained period of very robust activity, as I'm sure everyone in the room can understand and attest if you're a practitioner in this market. Since the beginning of 2017, we've seen average EBITDA multiples in our world from basically the mid sevens. That's the highest we've seen in the history of GF Data, which goes back to data reporting from 2003. We've never had average highs quite that much. Q1 showed an average of 6.9 times. Q4 showed an average of 8 times. You might think, wow, there's a big drop off. But as I said, I think our tendency would be to average those 2 quarters and talk about unprecedented valuation trends. We have seen that continue. Here's some little more granular data. Obviously, the size premium in Q1 returned to record levels. We split the data by deals with 10 to 50 million in enterprise value versus 50 to 250. Take a look at that at the size premium. The size premium was 5.8 times multiple average on the 10 to $50 million enterprise value deals versus 9.2 times for between 100 and 250 of enterprise value. So as big a size premium as we've seen. We also measured deals in terms of quality, where we say, okay, all these deals are completed transactions by private equity sponsors, so they've met that test. But then we say, let's separate the A's from the B pluses or the A's from the B's and say, okay, if you have 10% average revenue growth on a TTM basis, as well as 10% EBITDA margins, we're going to put you in a category called above average and compare that data set to the rest of the data. And we call that the quality premium. That was at a sustained, it's been at a sustained high. Higher quality deals are always in demand, but even more in demand in a market now where I think it's getting sort of long in the tooth cycle-wise. And that was a turn and a half of valuation, about 6 times to 7.5 times for the 7.5 times for the above average performers versus 6 times or so for the all other deals in the database, about 121% premium in valuation. And those higher quality deals encompassed about 61% of the deals in the database. So more than half the deals meet that test. We'll talk about leverage a lot more during our talk today, and we're going to go through a number of topics, but the past 5 quarters, the average total debt on deals has been about 4.2x. Again, that's a high. Just to keep it kind of top level, and the equity contribution in the capital structure has been hovering about 42% of the capital structure, and that's low. That's being driven by a lot of debt availability on these deals. Anyway, so we're going to get into the talk now. I think if we can sort of just go through the group, I mean, overall valuations have averaged in the mid-sevens. That's a jump from levels that were already elevated in 2016. I mean, this has been a long cycle and a very sustained M&A market. For larger deals, the data bears out that double-digit multiples are routine. I think anecdotally, we can all in the room say, geez, we've seen some crazy stuff lately. And I know from our business at Private Capital Research, we've been outbid on a lot of deals, and a lot of really aggressive pricing has been happening. So what is sustaining this unprecedented headiness in the market? And are we seeing any signs of retrenchment? Maybe, Jason, you could give us your thoughts. I'd love to just sort of get through the group on an overall basis of kind of a market look.
Yeah, hopefully I don't take all of your guys' talking points, but to me, it's pretty simple, right? It's you've got more motivated buyers than you've ever had, and you've got what I think are fairly apathetic sellers, right? From the standpoint of why are sellers apathetic? You can sell a business for a great multiple, or you can just hold it. But if you don't sell it for a great multiple, your reinvestment alternatives are pretty low, right? So that drives an apathetic seller. And you got motivated buyers. Why do you have motivated buyers? There's just a lot of money out there. I mean, I really think today's market and what you've seen, is a result of years and years of very low interest rates and terrible reinvestment alternatives, right? And so institutional capital is, and that's not just institutional capital. It's our capital as more of a family office. Anybody who wants to invest capital is flocking towards alternative assets because interest rates have been low for coming up on 10 years, and I don't really see that changing anytime soon. So to me, it's a very simple, supply and demand kind of dynamic. I saw a chart one time that I thought was very interesting, which was, 20 years ago, right, there were, 1,000 private equity firms. Today, there are 7,000 private equity firms, right? The rate of growth of firms that are investing in the lower middle market is substantially greater than the rate of growth of the overall economy, right? So it shouldn't be any surprise that we are where we are.
Yeah, I would agree with that. I think what's interesting to me, though, is, and I mentioned we value these 1,300 portfolio companies, only half of the portfolio companies that we value are experiencing year-over-year EBITDA or revenue growth, just approximately half. So if you think about the environment that we're sitting in today, and you couple that with the fundamentals, we're not really seeing such strong fundamentals to correlate with the multiple levels that are being observed. I think this is just kind of a function of the fact that you need to put your capital to work, and this is the environment that we're in. So it's a matter of just picking your spots and making sure that you're comfortable with the management team, you're comfortable with the level of EBITDA that the company's generating. And the other point I would say is that the EBITDA is extremely important, and the number of adjustments and the magnitude of the adjustments that we're observing on some of these transactions is at all-time highs. I would say that on average, the percentage of adjustments on EBITDA is anywhere between 20 to 35%, which is pretty high. And not all the time is it just a transaction expense add back or transaction fee add back. It could be a function of synergies that may or may not be realized. So I think there's just a lot of risk in the fundamentals of the business, and I would agree with what has already been said. I don't know when it's going to kind of reverse. I think there's some geopolitical risk that we don't really know what's going to happen.
So I guess I'll be, the supply-demand imbalance is really a big catalyst right now for value. We're seeing very few businesses that have excellent management teams, actionable growth plan that they're delivering on, and tailwinds in their markets. When we see those businesses, it's kind of a barbell. Those businesses are going for big multiples, and people are bidding them up, and lenders are supporting those companies. If it's cyclical, industrial, it's on the other end of the spectrum. No real growth. They're following, the trends in their cycle. They don't talk to their customers. Those businesses, I would say, are still trading for modest multiples. And by modest, it's 5 times and potentially less in kind of heavy industrials. But if it's asset light, service, great management teams, regardless of size, 10 plus is in the cards, which to me is shocking, in today's market. But it's really a flight to quality and still kind of being driven by the recession. But we're turning down more pitches than we're taking right now because we're seeing more entrepreneurs that just aren't ready for prime time, and trying to give them, here's a hit list of everything you need to do. Here are the bodies you need to add, to your management team, and go get an audit. But if it's not institutional quality, we're not touching the deals today.
Yeah, I would echo everything that my other panelists have said, and I think the biggest thing really has been just the flood of capital coming into both the debt and the equity markets, as was mentioned, in search for a yield, given the environment that we are in currently. And just to kind of provide some stats around that as it pertains to the debt markets, if you look at the amount of capital that's been raised by BDCs, middle market CLOs, debt funds, mezzanine funds, in 2016, it was 60 billion, around 60 billion. 2017 was almost 70 billion, which is a record. And 2018, this year, is on track to mirror 2017. So it's a huge inflow of capital coming into the markets. Most of this is directed at the upper end of the middle market, and that's supporting these double-digit valuations that people are talking about. The latest stat per S&P for the second quarter was valuations around 11.6 times for the middle market, class as a whole. So middle market here is defined as companies up to 50 million of EBITDA.
Okay.
Yeah, I mean, I just to touch on something real quick, though. I mean, I think that there is obviously merit in the argument that debt levels help support valuation levels. So if you're buying something for 10 times and you can get 5 or 5.5 times leverage, it certainly helps. But from my perspective as an equity investor, I still have to believe that the business is actually worth 10 times, right? Regardless of how much I can borrow. And that I think is really the critical sort of question for equity investors today, which is, do you really think that business is going to be worth 10 times forever, right? Like, private equity used to generate a lot of its return from multiple arbitrage, and I would argue and submit that, they're destroying a lot of that arbitrage today.
No, I don't disagree with that. One of the things that Homyar mentioned was the higher multiples for some S&P data in the 11s on the average, which is, I guess, up to 50 million of EBITDA. Mm-hmm. So that's obviously a sort of an average number. One of the things that, this is a chart from our friends at Mercer Capital, valuation firm, pretty highly respected. And this actually compares the Russell 2000 with the S&P 500 and also the GF data numbers, which is the 100 to 250 valuation range, which really doesn't encompass up to 50 million of EBITDA. My suspicion is that a lot of the S&P data is publicly disclosed information, so they maybe have a public component to the data. And so you can see here the difference between the lower middle market and the public markets, or the really what I would call like the upper middle market. And even though multiples are up, these are sort of directionally correlated. I think as cycles go, multiples sort of follow one another in a lot of ways in a big picture basis. But I think one of the points to make is that living in the lower middle market, which is where we live, I know Jason, and actually I think we're all kind of camped out in more towards the lower middle market than we are in the more the public space. There is still value to be had, and I think that's something that we take a lot of solace in. But I think Jason's really got a point, is that, how is that going to fare in the next recession? How are the multiples that we're paying today going to make it? And I think it's one of the reasons why we're seeing such a spike in the quality premium, because I think people are willing to pay up for higher quality assets because maybe they're not going to get as hammered in a downturn. And one of the things that we've also tracked is the other deals, and watching the upward movement in those valuations. And that's the kind of thing that's starting to give us a little bit of pause and scare us a little bit, because once we start seeing the lesser quality assets getting bid up very aggressively, we start to think, okay, what's the outcome on that situation? It seems like a lot of it's driven by the LPs, who just need to have money put to work, and frankly, the valuations that they're getting are, the returns they're getting are maybe better than some other assets. But when you're a firm like Keystone and you're investing your own money, patience all of a sudden starts to be part of the theme, I would think, and you start to wonder about where it's really going to come out on the other end.
I was just going to say, the other way we've seen private equity firms justify some of these higher multiples is by doing a lot of add-ons. So it's much easier for them to pay up for an asset when they know that they're going to be able to take out some costs and have some synergies. So a lot of times they know they're overpaying for an asset when they're buying a platform company, but they have a game plan that over time, hopefully, will be able to average that multiple down. And sometimes it works, sometimes it doesn't.
Right. Well, while we're on the subject, Brian, I'd love to have you maybe talk a little bit about what you guys have been doing at Lincoln with a tremendous amount of information, and how you're seeing, I have that one slide on the multiple evolution here, and maybe you could explain about the MMI and what's going on within your shop.
Sure. So as I mentioned, we are valuing portfolio companies for fair value purposes on a recurring basis, on a quarterly basis. And so in 2011, we elected to push all that data into a database and formed the Lincoln's database. What's presented on here is a multiple evolution chart, and it basically echoes what the panelists have already said. You'll see in December of 2013, approximately 25% of the portfolio companies in the 1,300 set were valued at 9 times or greater. That percentage has now jumped up to about half the portfolio companies being valued at 9 times or greater, which is astonishing over that short period of time, that it doubled the percentage of portfolio companies are being valued at that magnitude. On the flip side, for portfolio companies that are valued at 6 times or less, only about 20% of the portfolio companies were valued at six times or less in 2013, and that's declined to about 12% in the current quarter as of March. Let's just take it down a level, which is not on the slide, because I know we're very interested in the lower middle market. So if you're $0 to $10 million of EBITDA in Q4 of 13, your EBITDA multiple level on average was around 6.5 times. That's jumped up a full turn to 7.5 times, which kind of hits exactly what Graeme was saying. Mid-sevens is what we're observing as well in the $10 million or less. You go a little bit higher up in the market for a $10 to $30 million of EBITDA. In Q4 of 13, we were averaging around 7.5 times when we were doing our valuations. Now we're up to about 9 times. So it's interesting, if you just kind of go up a little bit in the market to the $10 to $30 million bucket, you're seeing about a 1.5 times increase, and you're at that 9 times level, just shy of the double-digit multiple. Concurrent with the database, we felt it would be interesting to actually see if we were to come up with an index of fair valuations, what that would tell us. And so in collaboration with actually 2 professors out of the University of Chicago Booth School of Business, Professors Mike Minnis and Steve Kaplan, and Steve is the guru of private equity, for those that don't know him. He helped collaborate with us, and we developed what's called the LMMI, the Lincoln Middle Market Index. What's presented on the slide here is a breakdown of the LMMI, and it's broken down by industry. And what you can see over since 2014 is an exacerbated growth, and you're seeing that growth in all industries, with technology and industrials growing at a faster rate than the other industries. That red line is the energy sector, which came down. As you all know, there was the energy crisis that took place, but since 2014, we're seeing a rebound. The energy sector, on average, we have not observed that rebound kind of clip where it was back in 2014, but we are seeing a rebound in that sector, and it's a function of higher oil and gas prices. There's another slide in here that actually shows the LMMI in aggregate. If you could, what we put up there. So this is the LMMI, Lincoln's Middle Market Index. We compare that to the S&P 500. Similar to a slide that Graeme showed earlier, the reason we're doing that is we just want to see how we're faring against the public markets. And what we have observed is that the private markets have a correlation with the public markets on a valuation basis. However, the volatility of the public markets is not akin to that of the private markets. There's far less volatility in private company valuations than there are in public stock valuations, which is probably no shock to anybody in the room. But I think it just kind of proved that thesis. The other thing that I think is interesting is if you look at the most recent quarter, you'll observe that there was a slight decline in the enterprise value of the S&P 500, whereas in the LMMI, we're observing an expansion. So that just goes to show you that there is that correlation, but it's not always one for one.
Great. So, I'm convinced multiples are up. We're all seeing it. Ryan, are there lines of demarcation that you see in your business that are, not all businesses are trading for these lofty multiples? I mean, I know that I've also seen deals that are not going for the highest, best, largest multiple. What kind of lines of demarcation are you seeing drawn around what might be a good place for value, and also if maybe you're a seller, what's the area where you really ought to be thinking about the highest multiple?
So, I mentioned it at the beginning that, in terms of the key value drivers, the team is first and foremost. We're including more managers in management presentations than ever before. If we can get 5 or 6 people in the room telling the story, answering the questions, getting involved, you're selling depth. And we just sold a manufacturing company to a publicly traded company. It was $30 million in revenue. They're taking that management team and they're going to run a $500 million division. So the CEO of the publicly traded company told me 4 times, if management isn't on board, we're not bidding. And they bid 2 turns higher, than anybody else in the deal, and they were buying the team. We had great products, but they bought the team. In the industry, and it was the whole team. So if anybody dropped or wasn't signing up for 5+ years, that would have been a negative there. If you've got an exiting CEO, we're seeing there is value to be had. If there isn't a strong 2 or 3 or 4 who can be promoted. And in the, I'd say brands are the other thing that are driving tremendous value. If it's, branded industrial, branded consumer, people are paying up for that. Especially if and more market studies are being, performed to validate that. In terms of where, value is today, I'd say, the old line heavy industrial that has a cycle is still a good place to be. Leverage has never gotten crazy there. Everything's sub 4 times total debt in those deals, and up to 4.5, and that's regardless of size. We've worked on a company that has 70 million in EBITDA or 2, and the leverage is the same in the industrial sector. So that's, to me, where value is in something in the metal space that or just contract manufacturing, where we're seeing more value and not as many people playing in that field. I would say if you have a service business, we had a recurring revenue contracted service business. We sent out 100 books and got 60 bids. It was, kind of ridiculous, feeding frenzy, double-digit multiples. On the flip side, industrial, sole source, machining business that, I'd say they're by far the best in the industry and one of 4 companies probably in the world that can do what they're doing. That's going to, and they're 4 of EBITDA, great management team, but that's going to trade for 5 times. and leverage on it was 3 times total debt. So those are the, where we're seeing value. But anything that's tech-enabled business services, people are flocking to that and paying high numbers. And I'd say your traditional kind of really where the LBO world started in industrials is where there's some good value.
Thanks, Ryan. Jason, you guys have a little bit of a different angle on how to approach a competitive market. Why don't you maybe throw some insights in on how you guys go about addressing the situation?
Yeah, I mean, it's and Ryan, I think, made some great points on the last discussion. I mean, to me, the biggest demarcation that I've seen over the last 3 or 4 years is just recurring revenue. Like, I think a lot of what Ryan said is great about management and growth, actionable growth opportunities, and those types of things. I would also say those are the hardest things to evaluate, right? Because we've all had our fair share in our business. We've all had our fair share of CEOs that we thought were good that really didn't turn out to be very good. So recurring revenue is pretty easy to evaluate. I mean, that's very simple. So that's the biggest thing I've seen in terms of a premium. But Graeme, to answer your question, to be in the PE space right now you're in a pretty tough spot. It's probably the hardest it's ever been to differentiate yourself. And it's not only about price, it's also about terms. I mean, you're getting very little legal protection anymore. Very few terms are going your way. You're having to close faster. You're having to do less diligence than you ever did in the past. And so, it's not just about price. From our standpoint, we've all heard the term, these guys have an angle, right? Like, we've all heard that before. It's thrown around very loosely. But I think you have to have something, right? You either have to decide you're playing and you're going to win based on price, or you're not, right? And it's very simple. From our standpoint at Keystone, we could go through a broad list of ways that you try to differentiate yourself and compete. But from our standpoint, we try to differentiate ourselves by being, the preferred choice, right? Because we invest our own capital, we have a longer term horizon. We're a lot more patient. Management teams and business owners like that, right? They like the fact that they can operate without a 3 to 5 year time horizon. And so we try to find situations where that's going to have some value in the process. And yeah, it's not going to be to the ends of the earth. You're not going to sell a business that's worth eight times for 5 times, but hopefully it's worth something. We try to differentiate ourselves that way. We try to differentiate ourselves by having some industry knowledge in some areas like architecture, engineering, construction management, where we've got really good industry disciplines. That generates some level of deal flow for us. But overall, I mean, I think you just have to work hard right now, right? I mean, you've got to turn over lots of stones. You have to get on the road a lot. You've got to swing and miss a lot. And it's just become, a much bigger, broader field that you have to play in, So it's, to some degree, it comes back to old-fashioned work ethic as well.
Interesting. Well, in terms of valuation drivers, while we're on the topic, yeah, I mean, there's a bunch of different ways to look at it. One of the ways that we track at GF Data, at least for this, is we say, if we could sort of break down from a statistical perspective, what is actually driving value? And we take some of the components of that, such as the size premium, the quality premium, whether or not the seller is an institutional type of seller, like a private equity exit, versus a entrepreneur, family, private seller. We track whether the deal has a situation where the management has continuity, where they're going to be rolling over equity. And we're starting to collect data on the percentage of rollover equity and whether that instance is there or not, to start to correlate that around valuation even more in depth. But what we found is that if you look at each of those drivers, they have a factor in terms of valuation. I don't have the slide here, but I think it was probably on the rotation that's on our sponsor table. But if you take all 3 of those characteristics, a size premium, quality premium, and continuity of management, well, actually, and the corporate or institutional type of seller, and then you look at the size premium over time, what we found is that the real sweet spot in the lower middle market, the area where between 10 million and 250 million of enterprise value where we live, we have found this sweet spot area between 50 and 100 million creates the biggest value drivers, particularly if you're a seller, say, Jason, you got a portfolio company you're looking to exit, that with those drivers and in that $50 to $100 million size range, and some of this is driven by leverage, which we're going to talk a lot more about, but that is a differentiation on average that gets you from 8.3 times enterprise value to just north of 10 times enterprise value. So it's a little bit more than 1.7x in terms of EBITDA multiple arbitrage for having those kinds of characteristics. So when you're talking to business owners about what's driving value, there are a lot of factors, but at least some of these, are sort of definable where you can say, how are we doing against some of these metrics that are factors that are going to actually drive the value of your business. So, and in the same way, it works, as a buyer looking for value, trying to find ways that you can create those kinds of drivers during an ownership period. So let's shift gears now. I want to talk about leverage a little bit, which is driving so much of this. Homyar's an expert here on that subject, and would love to get your thoughts on just kind of start maybe with big picture and then dial in. But I mean, just since the last recession, the regulated banks have sort of had their wings clipped with a higher degree of regulation. I think that's maybe easing a little bit now, but that void has been filled by so many of these finance companies that have provided some debt capital. Can you comment on that evolution and where that is today and where it's going?
Sure. That evolution started a long time ago, even prior to the Great Recession, with the share of bank financings coming down. The latest slide that I saw was banks now are providing less than 10% of the financings in the market. So
for LPOs or
for overall. And so it's been a huge shift. It's not just been since the Great Recession, but it's been something that's been ongoing for a very long period of time. We can talk a little bit about kind of just the state of the debt markets in general. And since GF has some very good data as it pertains to enterprise value, et cetera, for the debt markets, we're going to rely on S&P and Thomson Reuters to provide you some stats here. I ask for your indulgence because a lot of this data pertains to larger companies. It's not necessarily the lower middle market data set that we're looking at. But I think the key takeaway from this is not so much the absolute levels, but the trends that we are seeing in the market. And that's the most important thing here. So just starting off at a high level in terms of volume, 2017 was a very good year, 13.5 billion of middle market transactions. Again, middle market being defined as less than 50 million. Second quarter, year to date, 5.3. Again, a very robust start to the year. As Graeme mentioned earlier, first quarter typically tends to be weaker, so you can't just annualize that number. So factoring that in, a very good start to 2018. All indications are it's going to be at least as robust as 2017. Also, of that $5.3 billion number, 57% of those deals were leveraged buyouts. So a lot of M&A activity is driving that volume, another healthy characteristic that we're seeing. Diving into the leverage and structure attributes that we're seeing in the market, if you look at middle market LBOs in the institutional market, leverage is at an all-time high. Second quarter institutional middle market deals, and institutional being, again, upper end of the middle market. These are typically credits that are rated, broadly syndicated to the institutional market. So second quarter, the leverage in the institutional middle market was over 6.25 turns. The previous peak of the institutional middle market, which was in the second quarter of 2007 during the Great Recession, was 5.75 times. So we have significantly exceeded the last peak. Looking at it another way, institutional middle market deals levered greater than or equal to 6 times comprise 60% right now. In the previous peak, it was in 2007, it was 25%. Again, we far exceeded where we were in the last cycle. Let's look at structure, covenant-light deals. That is becoming more prevalent in the middle market. Obviously, Cov-Lite has been around for a long time, but it's primarily been in the upper markets and the large cap markets. More and more that's gravitating now into the larger middle market transactions. So the percentage of the middle market institutional volume currently, that is Cov-Lite, is 40%. Again, if you go back to 2007, which was the last peak, it was half that, it was 20%. Another statistic where we've exceeded the last highs. Somebody here mentioned EBITDA adjustments. And let's take a look at kind of the EBITDA adjustments as pertains to companies less than 15 million of EBITDA first. So these are run rate, these are not transaction expense add backs, these are run rate synergy add backs, right? 45% of the deals with EBITDA less than 15 million had run rate synergy add backs. If you go 15 to 50 million of EBITDA, that number jumps to 78%. 57% of the respondents in a Thomson Reuters survey said that the average EBITDA adjustment was 20 to 30%. Moving on to pricing. Just like with leverage, when it comes to pricing, size matters. So first, let's take a look. We have some data for smaller companies here. So let's take a look at companies with less than 5 million of EBITDA. Less than 5 million of EBITDA, as Graeme mentioned earlier, leverage around 4.25 times. The yield, which includes the LIBOR spread, averages to around 9.5%. 15 to 25 of EBITDA, leverage creeps up slightly to around 4.5 times. Pricing comes down 175 basis points to 7.75%. And if you go over 40 million of EBITDA, leverage jumps to 5.25 times, and pricing comes down another 100 basis points to 6.75%. So again, I guess the key takeaway from all this is where the market is right now seems to be at a point where at a higher point than where we were prior to the last Great Recession, and certainly feels like the state of the market right now is very frothy.
Thank you, Homyar. Brian, maybe you can comment. This is some data from Lincoln, leverage multiples by industry.
Yeah, and what you can see here is that it doesn't matter what industry you're in, your multiple level is higher than it was back in Q4 of 13. And while some industries, the magnitude is not, at the 5 times level, like energy, which has had some headwinds, everything is rebounding. As we're going through our Q2 valuation, because this is all Q1 data, the one thing that we noticed that's prevalent in deals is what I'm categorizing as proactive repricing. So both lenders and sponsors are kind of forcing the issue on reevaluating the magnitude of their pricing and bringing that pricing in. And I'd be interested to see if you agree, Homyar, with that comment, because to me, it just kind of shows how competitive the debt markets are today, how there's so much volume there, and that if you're not, as a lender, thinking ahead, you're going to get refinanced out, and you may get into a situation where going through all the diligence for a deal to get comfortable with the deal, you're going to be in a worse off deal than you would have been if you would have just squeezed your pricing just a tad relative to where you are today.
Yeah, we're certainly seeing some of that. A lot of the repricing, though, that we're seeing happens in the context of add-on acquisitions. So when a sponsor is looking to do an add-on acquisition, that's typically the time when they come and say, well, the deal probably needs to be repriced. So we're seeing a fair amount of that, just in terms of lenders proactively reducing pricing as a defensive move, I haven't seen a lot of that happen.
And one of the things you harped on also was covenant light, and I have like a little quote from a Thomson Reuters presentation. So last year, and this is just coming right directly from them. So last year, 60% of lenders said that they would not do covenant light deals. This year, only 34% said that they would not do a covenant light deal. So that kind of just goes to show you kind of the state of the market. And I think this is just an inference, when they're saying cov light, I think they're just saying it has one covenant, typically total leverage covenant. And what I also would say is that just because you have a total leverage covenant doesn't mean it means much, because what if the magnitude of that leverage is 6.5, 7 times? Maybe you're not going to trip it, and I think it just calls into question whether it even has a covenant whatsoever. In our database, is kind of taking it a step down. For portfolio companies of $0 to $10 million EBITDA, we're seeing the same things that are being echoed by the panelists, where in Q4 of 13, the average max leverage was about 4 times. Today, we're up to about 4.7 times. And then for $10 to $30 million of EBITDA, we are seeing leverage creep up to about 5 times, whereas in Q4 of 13, it was about 4.25.
Okay, yeah. So we at GF Data, we publish a leverage report on a quarterly basis that's a companion report to our M&A valuation report. And I think we're in line. Clearly, I think size matters, as Homyar said. The debt levels are unprecedented, and the averages that we're seeing, and these are averages of private equity sponsored deals, sort of 10 to 250. So it's definitely decidedly lower middle market data we're talking about here with GF Data, but the average is about 4.2 times, and it's kind of sustained that way through 2017 on the average and the beginning of 2018 on the average. There are, if you slice and dice and drill down under that, you see a lot of movement around there. The sub-debt is really, although I know that's a very competitive market today, the average multiple of sub-debt in the capital structure when it's used is remarkably consistent going back over a long period of time. I mean, 0.8 of a turn to 1 turn is pretty darn common. And frankly, the pricing on the sub-debt hasn't varied a whole lot either. In terms of, so overall debt 4.2 times is kind of what we've been seeing on a sustained basis. When it comes to pricing, as you can see from this chart, LIBOR has risen approximately 150 basis points, maybe a little more, from around 0.8% on 90-day LIBOR, which is the sort of the base sort of pricing metric, to about 2.3 times, or 2.3%, from 0.8% to 2.3% for LIBOR. So as you can see, the cost of capital is simply rising. We're talking covenant light. We're talking about rising cost of capital. As you can see, as you got into Q3 and Q4, and again, Q1, let's not read too much into Q1 because of the volume, et cetera, what we've talked about, but we're starting to see the spreads compress a little bit. And we've got some pretty detailed data on this for lower middle market sliced by 10 to 25 enterprise value, 25 to 50, 50 to 100, and 100 to 250. So there is a lot of differentiation if you start to really kind of slice it. But the reality is that the competition out there is keeping the price to the buyer in line, and that those spreads have compressed. So while the cost of capital rises, the covenants become lighter, the pricing, is getting sort of squeezed. It starts to beg the question, kind of where are we headed in this cycle from a debt perspective? And I'm just curious. You guys are deep in this, Homyar. What are people thinking, or what are you guys thinking about? The next 6 months or so.
Well, I think the good news is that it seems like leverage levels are pretty much at the peak, and while there is quarter to quarter been some fluctuation in the average numbers, it's not been dramatic move over the past several quarters. So, again, that's not very comforting given the levels we are at right now, even if it stays at this level. But it's not only just the leverage levels, it's not only just the pricing, it's again, as what some of the panelists said, I think it was Jason who said, what happens with some of the other terms, right? What you're seeing in terms of pressure on diligence, what you're seeing in terms of the quality of information that's provided, the opportunity to dig into that information. So all of those things seem to be, seem to kind of persist. And it's anybody's guess as to what's going to cause it to turn.
Okay. Well, we're getting closer on time here, but we did want to address one other topic, which was deal risk mitigation and things that people are doing on the sell side to make it so that when a deal is priced to perfection, is it actually going to get to the goal line on that number? And also, we're going to talk a little bit about other levers to pull in that environment, such as the use of rep and warranty insurance and on deal terms, and what's happening with indemnification and holdbacks on deals. We keep some pretty robust data on that on that as well. Just to sort of mention the things about some key deal terms. We published a report on key deal terms, but the indemnification caps are generally down overall. They trended in the 16 to 18% for lower middle market for a long period of time, up through 2016. The average is now 6% on indemnification caps, and a lot of that has to do with the instance and the use of rep and warranty insurance and how that has trickled down more into the lower middle market and created, again, it's a factor of a seller's market. We get to a point where, pricing is maxed, leverage is maxed. Well, what other levers are there to pull? And in a seller's market, it's, hey, let's cut back on the holdbacks here. Let's lay that risk off instead of, keeping that in escrow and a holdback on an indemnification. Let's see if the insurance companies are going to take that risk. And so we've started to see the instance of that in 2016. 7.7% of all the deals that we collect data on at GF Data alone, 7.7% of deals had that rep and warranty insurance, whereas in 2017 as a whole, 42% of all the deals that we collected data on had rep and warranty insurance. So you're starting to really see this become a big factor, and particularly moving down into the lower middle market where it really didn't exist before. And in the larger segment of our lower middle market, the $50 to $250 million enterprise value deals, in 2017, 65.6% of the deals had that insurance, which is really great for sellers. It's one of those things that just persists in what is a really strong market. But I'd love to go down and particularly, Ryan, maybe talk about some other factors in terms of deal risk mitigation for sellers to, how do you get the deal to a close when all these factors are maxing out as you get to an LOI?
Yeah. So, our saying in our shop is time is the enemy of all deals. And we're prepping our clients more and more and spending more time, up front. We're recommending and almost won't take an assignment now if the seller isn't willing to do a sell-side Q of E. I don't care how many audits, if it's private equity owned or corporate owned. I have never seen a business that, closes their books the same as they do at year end on a month-to-month basis. And, buyers are smart. They're hiring good accounting firms and they're coming back. The retrade is a consistent theme, and we're trying to avoid that these days with everything priced to perfection. So sell side Q of E is a great thing. It gets your management team prepared for what's coming. It also sets a roadmap for the buyers to follow. We're actually having all the Q of E providers play the point on follow-up questions as well. So you have Grant Thornton talking to BDO. That's a lot better than Grant Thornton talking to our management team in terms of validating add backs and adjustments where we mentioned earlier it's 25% of EBITDA these days. If it's an unusual industry, we're trying to do a market study as well. That's a harder sell for people right now. Strategic plans are great if you've got those, but any type of roadmap that can be validated is taking risk out. From rep and warranty insurance, law firms now are writing that into every agreement. In every deal we do, we actually put a purchase agreement to have people bid off of. We're actually now taking it a step further and actually having the disclosure schedules written. So again, doing things to take risk out of the deal. Rep and warranty insurance, I'm one of the probably few, I hate it. I've had 2 deals break because of it, and it's really the lack of education, in the market. Depending on the size of the deal, I would say big law firms get it. They know how to use it to their advantage. Smaller firms haven't seen it enough to understand it. If you've got a perfect, clean company that has no issues, it's a great product. I haven't seen one of those yet. So every company, there's some issue out there that, 4 years ago you could have boxed it and come to an agreement. Now the seller thinks they're covered by this policy, and yet they've got a $70 million exclusion carve out that, the buyer would have said, yeah, we can put that under a $4 million cap, but now it's an exclusion from the policy, and I want the perfect, I'm paying the price premium here. I need this to be perfect, and it's it's causing issues. So we're trying to prep and understand everything well in advance of picking up the phone and making the first call on a deal.
Are you finding that the level of diligence on the rep and warranty insurance is from the insurance companies is as in depth and robust as what you'd see on from a typical buyer?
So that's the other fault for the uneducated buyer. The rep and warranty insurance companies shouldn't have access to the data room. They should be working off of the diligence reports that the buyer used. As soon as the insurance company gets in there, or the underwriter gets into the data room, they're going to start asking questions and changing, the policy and the diligence path. So that to me is scary when that happens. I won't allow it on our deals. We're getting the requests, every time there's a policy, but that's something that the market needs to get more educated on the product.
Well, we're kind of running out of time. I don't know. Maybe is there any? Do we have any Q&A? Is there anyone that Pat?
$575 back in 7. What was it 2 years later at the bottom of the market in 2009? How much did leverage drop 575 when we got into 2009? I'm estimating it was about 2 turns, maybe a turn and a half, but 2 turns. Do you have any recollection of that?
I don't. But I mean, I think it probably 2 turns around, 2 turns probably sounds, but I don't have that number on my fingertips.
So as we're sort of factoring in the risk that we're taking right now with these kind of leverage,
Yeah.
we need to understand there's probably a couple of turns that might
Yeah.
go away if people get scared for whatever reason
Right.
that might be.
Right.
I don't know what that reason is. I
Yeah.
don't know if you have an idea, but that's what I keep looking for.
And it was if you could get it. Yes, in the yellow shirt.
Yeah, I would say that, we're aware of that, but it's not something we've spent a lot of time on. But, and I'm not sure that is, I don't know as much about it clearly as you, but I don't think that applies to all industries. I think it's somewhat specific. So it's not something that is on our horizon today, from my own standpoint. Ryan, I don't know if you're seeing that with your clients.
We're paying attention, and we're going through it as a firm as well. So
Yeah.
we're changing audit firms, and it's it'll have a huge impact on Cleary Gull, and I don't want to do it, so we're trying to find the least conservative accounting firm out there right now. Because they're saying retainers aren't going to be, if you have a deal that doesn't close, you can never book that. The most conservative approach is you can never book that retainer, even if the engagement letter's canceled. But we are getting in front of it and trying to look at it, and that's where the sell-side QOV is going to be more and more important in terms of pro-forming the financials back to show, to show the comparables.
Maybe one more.
Hey, Graeme. Yeah, so yesterday I showed you this article from PitchBook. They came out yesterday talking about fundraising and new formation, private equity capital plummeting was their quote in 2018. So are you guys seeing that as a result, or do you think that's just a blip on the screen, or is this a result of oversupply of capital and undersupply of deals? And is the investor, are the LPs getting smart and saying we're just not going there anymore?
It's a good question. Jason doesn't really use LPs. I don't know that we have an expert on the panel unless somebody wants to take it.
I have some ideas on the subject. I mean, I think part of what's happening there is so much capital out there. It can't be invested fast enough. So why throw it at investment managers and pay them fees if they're not going to be able to invest it anyway? So I think that's part of it. I also think, and then I'll let Ryan fill in here with one last comment, but I also think that it's also a function of there are more family offices and alternative sources that are going direct, right? They're bypassing investment managers entirely. So it doesn't mean there's less capital out there. It just may mean there's a different form of it.
Yeah, I think it's just a blip in time. I'm taking more diligence calls for new funds and groups that are going from, $500 million to $1.25 billion in terms of the size of the funds, and they're raising it in weeks or months. So it's for the funds that have good performance records. It's easy. So I really view it's just a blip in time right now. By the end of the year, we're going to see it's going to be another record year of capital raises.
The only thing I would add to that is I think where that statistic might be true is first-time fund. If you're a first-time fund trying to raise in the market, it is a tough market. But if you're not, I think it's absolutely correct. I think funds are getting raised in record time.
Yeah. Right, and the other thing that's a little bit of a headwind right now is just the SBIC program. There's groups that have been working to get their money, from the SBA program for over a year now, and they've got great track records. So that has a little blip. It's not as much, but that is something that is influencing right now. The backlog of groups that are waiting for the green light is pretty significant.
All right, we're over our time. I can't thank you guys all enough for taking the time to come and join in this discussion. Thank you all for coming.